Welcome back to the Pro Ticker Podcast, everyone, your Friday morning edition covering major financial magazine headlines.
Indeed.
It's hard to ignore the vibe in the markets right now.
Oh, yeah.
Stocks have definitely hit a bit of a rough patch lately. You can really feel that investor anxiety sort of ratcheting up,
Yeah,
especially with all the talk about potential tariffs swirling around.
for sure.
And we even saw the S&P 500 officially dip into correction territory.
It has been quite the swift change from what we saw earlier this year.
Yeah.
The speed of this pullback, I think, has caught a lot of people off guard.
Yeah.
And those trade worries are definitely a major factor. I mean, it really makes you wonder how deeply these concerns are embedded in investor thinking right now.
Yeah, absolutely. So our mission with this deep dive today is to really dissect these headlines, pull out the crucial insights that can help you understand what's driving the current market and, maybe even get a glimpse of what could be coming down the road. We've got a bunch of different angles to explore today, from historical comparisons that might actually surprise you to the opinions of some really sharp market experts, all aimed at bringing some clarity to this uncertain landscape.
Yeah, I mean, in times like these, it's really crucial to look at things from multiple perspectives, right?
Definitely.
Historical context can be so valuable, and understanding how seasoned pros are reading the situation can really empower you to form your own, well-reasoned conclusions.
Okay, let's unpack this. One of the really thought-provoking comparisons I came across is from Tom Lee at Fundstrat Global Advisors. Now, he's generally considered a market bull, right?
Yes.
And he's drawing this analogy between the current sell-off and something as dramatic as the 1962 Cuban Missile Crisis.
Wow. Okay, so what's interesting here, I think, is this, attempt to find parallels with a period of, genuine existential threat.
Yeah.
I mean, the Cuban Missile Crisis, like you said, brought the world to the brink of nuclear war.
Yeah.
It really highlights just how much concern Lee is seeing in the market right now.
Exactly.
Lee points out that during those really tense 12 days in October of '62,
The market actually dipped about 5% in the first week. But then in the following 5 days, it bounced back roughly 4%, recovering, about two-thirds of that initial loss.
So we saw that sharp initial reaction, right? That flight to safety and then a partial recovery.
Yeah.
Maybe as, cooler heads prevailed or the immediate danger seemed to recede a little bit.
Yeah.
It shows how quickly sentiment can change even during periods of really intense uncertainty.
Right now, here's where it gets really interesting. Lee emphasizes that the current market drop, which is around 10% due to those tariff anxieties, has actually been larger than that initial reaction during the Cuban Missile Crisis.
Wow.
Think about that for a second.
That really puts things into perspective, doesn't it?
Yeah.
It suggests that investors are viewing the potential fallout from these trade disputes with a level of concern that, arguably surpasses even the fear of global annihilation back then. Right. And Lee doesn't stop there. He actually anticipates that the market will find its footing before the April 2nd tariff deadline.
Oh, okay.
His reasoning is that we might see some, positive movement in the negotiations.
Yeah.
He also notes that there's been a decrease in the really aggressive trade bashing of China and Mexico recently, which he sees as a potentially encouraging sign.
I see. Yeah. So that's an important point about the rhetoric, right?
Yeah.
Market sentiment is often heavily influenced by the tone of these discussions. So, a move towards more conciliatory language or even a pause in those aggressive statements could definitely, help to calm nerves and potentially lead to that stabilization Lee is predicting.
He also brings up this observation that the stock markets of countries that stand to be most affected by these tariffs, like China, Europe, Mexico, Canada,
Right.
have actually outperformed the U.S. in recent weeks.
Oh, interesting.
And he reminds us of a historical precedent from 2018, where U.S. stocks actually bottomed out before the actual tariff deadlines came into effect. So these are some really important data points to consider, right?
Yeah, I mean, the relative strength in those international markets, it could mean that investors there have already adjusted their expectations or they're finding opportunities even amidst the trade uncertainty.
Yeah.
And the 2018 parallel, it serves as a reminder that market behavior around these events isn't always linear or predictable.
Right. Speaking of potential factors that could sway the market, we also have the Fed policy decision coming up next week.
Oh.
Now, the general expectation, according to Lee and others, is that we won't see an interest rate cut at this meeting.
Right. That seems to be the consensus view, especially given the Fed's recent communication suggesting a more data-dependent and patient stance.
Yeah.
But, the real focus will be on what Chair Powell has to say.
Absolutely. With all this uncertainty around tariffs and its potential impact on, both household spending and corporate investment, Powell's take on the current outlook is going to be under some serious scrutiny.
Yeah, no doubt.
Lee anticipates a non-hawkish Fed, especially when you consider the, relatively tame inflation data
Yeah.
and some of those emerging signals pointing towards a potential slowdown.
So a more cautious tone from the Fed could be good news for the markets, right? It might, reassure investors that they're aware of the risks and are ready to act if needed.
Now, on the technical side of things, Lee's colleague at Fundstrat, Mark Newton, who's a technical strategist,
Okay.
he also sees some potentially encouraging signs. He's anticipating that a low point in this current sell-off could emerge within the next couple of weeks,
Oh, interesting.
pointing to the fact that prices are nearing levels where they might find technical support.
Right. So for those who maybe aren't as familiar with technical analysis, think of support levels as these price points where historically buying interest has stepped in
Yeah.
and prevented further declines.
Okay, so now shifting gears completely.
Okay.
Let's talk about gold. This week marked a pretty significant event.
Yeah.
Gold broke through the $3,000 an ounce mark for the first time ever. This was reported by Bloomberg, and it's quite a statement. Gold is often seen as a safe haven asset, a place investors flock to when things get shaky.
Right.
So this move really underscores just how much unease there is out there.
For sure, gold has always been a hedge against inflation and economic uncertainty.
Yeah.
And this move above 3,000 really reflects that.
The Bloomberg article highlights several key factors behind this surge. One is substantial buying from central banks, with countries like China, Poland, India, and Turkey specifically mentioned as major players.
Uh-huh.
Then there's that overall sense of economic fragility that we've been talking about. And of course, President Trump's trade policies are a factor in this equation as well.
Yeah, that central bank buying is critical. It points to a broader shift in global financial dynamics, right? Where
Yeah.
some countries are looking to diversify away from traditional reserve currencies, like the US dollar.
Okay.
This often reflects concerns about, geopolitical stability and the potential for financial sanctions. And the economic fragility we're seeing globally only strengthens gold's appeal as a store of value during uncertain times.
And it's interesting to note the sheer volume of gold flowing into the COMEX futures exchange in New York. It's over 23 million ounces, worth around $70 billion since the election.
Wow.
Apparently, this influx was so big that it even contributed to a record U.S. trade deficit in January.
Wow. So what's the significance of this movement of physical gold?
Well, it suggests that investors aren't just trading paper contracts, they're seeking actual possession of the metal, likely as a tangible hedge against potential financial or economic disruptions.
Right. That's a massive amount of physical gold,
Yeah.
underscoring the, conviction some investors have in holding this asset directly.
Yeah.
And the fact that it contributed to a wider trade deficit, that's an interesting and perhaps unintended consequence, highlighting the real-world impact of these investment shifts.
Now, what's kind of counterintuitive is that gold's rally has come despite higher interest rates and a strong U.S. dollar.
Yeah.
Usually those are headwinds for the metal because, higher rates offer return on other assets, and a strong dollar makes gold more expensive for international buyers.
Yeah, that's a really important point, and it speaks to the strength of those underlying drivers.
Yeah.
Even though higher interest rates make fixed income investments more attractive and a strong dollar makes gold pricier for foreign buyers, the anxieties about economic stability and the potential consequences of trade policy are overriding those traditional relationships.
Totally. And the Bloomberg article explains how Chinese investors, for example, facing a weakening yuan, have been buying a lot of gold, effectively offsetting the impact of a strong dollar for them.
Interesting.
So, you see how different global dynamics are sort of intertwining here.
Absolutely.
And the article also mentions this fear of missing out phenomenon.
Right.
After gold broke through those key price levels,
Yeah.
there was this growing sense that investors who'd been waiting on the sidelines were now worried about missing out on further gains.
Right. FOMO, as they call it, is a powerful force in any market rally.
Yeah.
Once a key threshold is broken, you can get this snowball effect where more and more investors jump in fearing that they'll be left behind.
Yeah.
This can sometimes lead to price movements that aren't entirely based on fundamentals.
Looking ahead, the aggressive and kind of unpredictable nature of U.S. trade policy is identified as a major factor that could drive gold's performance throughout 2025. And Jeffrey Gundlach, the CEO of DoubleLine Capital,
Okay.
he's actually predicting that gold could reach $4,000 an ounce.
Oh.
pointing specifically to those increased central bank purchases as a key driver.
Yeah, Gundlach has been a long-time gold bull, so his continued bullishness is certainly noteworthy.
Yeah.
The fact that he specifically highlights the sustained demand from central banks provides a pretty strong argument for higher prices, somewhat independent of short-term market fluctuations.
Yeah.
So while 4,000 is ambitious, it definitely underscores the potential for further gains if these underlying drivers persist.
This was reported by MarketWatch, by the way. Okay, now shifting our focus to Asia. It was interesting to see that markets there actually had a pretty positive day,
Oh,
despite the big sell-off we saw in the U.S. on Thursday.
interesting.
This came from CNBC's live blog coverage of Asia markets, and it really raises questions about the, regional dynamics at play.
Yeah, I mean, it suggests that conditions and sentiment in Asia might be somewhat insulated from, or at least reacting differently to,
Yeah.
the global concerns coming from U.S. trade policies.
Right.
It really highlights how the global economy is becoming more and more multipolar.
Mainland China's CSI 300 index actually led the gains, showing a significant increase, and Hong Kong's Hang Seng index also experienced strong upward momentum.
Okay.
Digging into the sectors, it seems, healthcare and consumer-related stocks were particularly strong in China,
Mm-hmm.
while in Hong Kong, names like Wuxi Biologics, BYD Meituan, and Ping An Insurance were notable performers.
Interesting. So what do you think is driving that strength in China despite the global headwinds?
It could be related to specific domestic policy initiatives,
Right.
or maybe improving economic data within China itself.
Yeah, the strong performance of those specific Hong Kong-listed companies, suggests sector-specific optimism or maybe some strong earnings reports.
Yeah, Japan's Nikkei 225 and Topix indexes
Right.
also closed in positive territory, while South Korea's Kospi dipped slightly, but the more growth-oriented Kazakh index actually advanced.
Okay.
And Australia's S&P ASX 200 also saw gains, with gold mining companies like Bellevue Gold and Newmont Corporation showing strong rallies, which of course ties back to this strong performance we're seeing in gold.
Right. So even amidst that broader uncertainty, specific sectors and regions can still find those positive catalysts.
Yeah, absolutely. Now, Michael Stroback from Lombard Odier offered a really interesting perspective on all this, noting that President Trump's policies are creating a significant level of market risk.
Mm-hmm.
His advice to investors was to filter out the noise and maintain a well-diversified portfolio.
Right. That's very sound advice. Diversification is so important for managing risk.
Yeah.
Helping to cushion the blow of any single event or policy shift.
Exactly.
Focusing on long-term fundamentals rather than trying to time the market is usually the more prudent approach.
Yeah, for sure. We also saw that U.S. futures actually experienced a bit of a bounce after Thursday's losses, which, might signal that some of that anxiety is easing.
Okay.
And there were those ongoing expectations of easing measures from the People's Bank of China, as well as initiatives to boost domestic consumption, which could be providing some underlying support to sentiment in those Asian markets.
Right. The rebound in U.S. futures could be a temporary pause in the selling or perhaps some bargain hunting after those recent declines. And, the anticipation of policy support from China can definitely act as a positive catalyst for the region, signaling, future growth potential.
Okay, now shifting back to the U.S., there's another potential source of volatility on the horizon.
What's that?
The risk of a U.S. government shut down the deadline to reach a funding agreement is midnight tonight, Friday. This is obviously being watched very closely and was covered by MarketWatch.
Government shutdowns are always a concern because they create uncertainty
Yeah.
about government operations, data releases, and potential disruptions to the economy.
The House of Representatives has passed a continuing resolution, which is a short-term funding bill. But its fate in the Senate is uncertain. The MarketWatch article suggests that this House bill is really the only option to avoid a shutdown.
Right. So the clock is ticking.
Yeah, it is interestingly, historical data shows that the S&P 500 has on average tended to rise both during and after shutdowns.
Oh, wow. That's interesting.
Yeah, the average gain in the year following a shutdown is actually pretty significant.
It seems counterintuitive.
It does, right?
Maybe it's because shutdowns are often seen as temporary political standoffs that don't really change the long-term trajectory of the economy.
Yeah.
But of course, past performance isn't a guarantee of future results.
Right. And the MarketWatch article makes this point that this time might be different because of the existing concerns about a slowdown and, of course, all those tariff uncertainties.
Yeah, a government shutdown could just add to the anxiety in an already nervous market.
Exactly,
Yeah.
potentially leading to a different outcome than we've seen historically.
Right, when the underlying sentiment is already fragile, and you've got these external risks like trade disputes,
Yeah.
an additional layer of uncertainty like a shutdown could have a more pronounced impact.
Right. The article also mentions a perspective that the administration might be willing to tolerate some short-term pain in the markets to achieve their policy goals.
So market reactions might not be the main driver of policy decisions right now.
Exactly, which could lead to, continued volatility.
Right.
Now, on a somewhat surprising note, despite the S&P 500's recent decline and the losses we've seen in tech stocks, retail investors actually kept pouring money into U.S. equities this past week.
Really?
Bloomberg reported a net inflow of about $7.3 billion.
Wow, that's a testament to the, resilience of retail investors and maybe that buy the dip mentality.
Yeah, and it wasn't just cautious buying either.
Yeah.
There were significant investments going into leveraged ETFs,
Interesting.
particularly those tracking the NASDAQ 100 like QQQ,
Right.
as well as those more thematic funds managed by Cathie Wood like ARKK.
Okay, so for those who don't know, leveraged ETFs aim to amplify the returns,
Yeah,
but they also amplify the losses.
exactly. So the appetite for these types of instruments among retail investors suggests that, a segment of the market is still quite bullish
Yeah,
and willing to take on that extra risk.
right.
The Bloomberg article points out this contrast with the more cautious approach from Wall Street pros,
Okay.
suggesting that a true market bottom might not happen until retail investors start pulling back.
Right. It's a classic signal many market observers look for, when retail enthusiasm starts to fade and you see more widespread selling.
Yeah.
So the fact that they're still actively buying, especially into those riskier areas of the market,
Right.
could mean that we haven't hit that point of maximum pessimism yet.
Right, which is often a precursor to a turnaround.
Exactly.
Now, this turbulence in the stock market seems to be spilling over into the corporate bond market, according to another Bloomberg report.
Oh, that's not good. The bond market is often seen as a more reliable indicator of economic health, isn't it?
Yeah, it's considered a leading indicator because bondholders are more focused on the long-term, solvency and creditworthiness of companies.
Right.
So any stress there can be a sign of bigger issues.
For sure.
The cost to protect high-grade corporate debt against default has actually risen to its highest point since August of last year.
Wow.
And we've seen some companies postponing their planned bond sales, and there are more cautious outlooks, even some bleak signals about consumer demand coming from companies like Adobe and American Eagle Outfitters.
Right. Widening credit spreads, which is that increased cost to insure against default, can be a real warning sign
Yeah.
of rising stress and potentially a precursor to a broader economic slowdown.
What's interesting is that the immediate trigger for this move in corporate bonds seemed to be President Trump's recent threat to slap a 200% tariff on alcoholic beverages from the European Union.
Wow, 200%.
Yeah, it really shows how interconnected everything is.
Yeah, that's a perfect example of how trade policy decisions can ripple across different markets.
Yeah.
I mean, the threat of those tariffs could directly impact the profitability and financial stability of companies in those sectors,
Right.
leading to higher risk premiums in their bonds.
Now, there's a thought-provoking suggestion from a UBS strategist, as reported by MarketWatch, about a potential $1 trillion shift away from U.S. equities by foreign investors.
Okay. A shift of that size could definitely have an impact.
Oh, yeah.
It shows how important those international capital flows are in determining market valuations.
The strategist argues that even a small percentage point reallocation of these huge holdings could translate into really big sell orders.
Right, because of the sheer scale of foreign ownership in U.S. equities.
Exactly. And there seems to be a growing interest in European equities, with ETFs like VGK performing well, potentially driven by Germany, and the EU's aim to boost spending.
Interesting.
So this potential shift can be driven by a few things, concerns about U.S. trade policies, the attractiveness of investment opportunities in other places,
Right.
and maybe a reevaluation of global growth prospects in general.
Yeah, concerns about the direction of U.S. policy, coupled with maybe a better economic outlook in Europe,
Yeah,
could definitely prompt investors to rebalance their portfolios.
totally. And the planned spending increases in Germany and the EU could be a positive signal for European equities.
For sure.
Adding to this, the MarketWatch article mentions that the U.S. dollar is weakening at the same time as U.S. stocks are falling.
Right.
And Deutsche Bank suggests that this could actually reduce the diversification benefits of holding unhedged U.S. assets for European investors.
That's a key point. Traditionally, the dollar has been a safe haven currency. But if both U.S. stocks and the dollar weaken at the same time, it makes U.S. assets less attractive to international investors.
Right now, across the Atlantic, there's some unexpected news out of the UK.
Oh, okay.
According to the Wall Street Journal, the UK economy actually contracted slightly in January, with GDP declining by 0.1%.
Huh.
This was weaker than most economists expected,
Right.
and it raises concerns about the near-term economic outlook there.
Yeah, I mean, coming in below expectations like that,
Yeah.
it's definitely unwelcome news, especially given their efforts to stimulate growth.
Right. And despite this contraction and those ongoing worries about inflation, the Bank of England is still expected to hold interest rates steady at their next meeting.
So the Bank of England is in a tough spot, right?
Yeah.
Trying to balance inflation control with the risk of further weakening the economy.
Exactly. This weaker growth also presents a challenge for the UK's Treasury chief as they work on their budget plans.
Yeah.
And reports suggest that UK firms are feeling less optimistic about the future and are even considering shrinking their workforces.
Mm-hmm.
And then you have the potential for new U.S. tariffs on UK and EU goods, which could further hurt growth prospects.
Right. The potential for new tariffs from the U.S. adds to the uncertainty.
Yeah.
And it could really hurt those export-oriented sectors like steel.
The Wall Street Journal specifically mentioned that UK steel exports to the U.S. are quite substantial and could be hit hard by these potential tariffs.
So yeah, it's a pretty concerning picture for the UK economy right now.
On a brighter note, there's good news from Japan.
Oh, okay.
The country is experiencing some significant wage increases, the largest in 3 decades.
Wow.
This was also reported by the Wall Street Journal.
That's great news for Japan. They've been struggling with deflation and stagnant wages for a long time.
Yeah, preliminary data from Rengo, the Japanese Trade Union Confederation, shows an average wage increase of over 5.46% for member unions, which is a big jump compared to last year.
That's huge.
These annual spring wage negotiations, often called Shinto, mostly involve larger companies, but the outcomes tend to influence decisions at smaller companies too.
Right.
This could fuel expectations for an interest rate hike from the Bank of Japan, which has had a very accommodative stance for a long time.
Yeah, the Bank of Japan has been hinting at a shift away from its ultra-loose policy.
Right.
Sustained wage growth across more companies would give them more confidence to raise rates and normalize policy.
The goal is to see this income growth spread and lead to more consumer spending.
Yeah, if this spreads to smaller businesses across the country, it could be a real turning point for the Japanese economy.
And the data shows that part-time workers are seeing some of the biggest wage gains, which is another positive sign.
Absolutely.
Finally, let's touch on the oil market.
Okay.
Have you seen oil prices going up, despite a rather gloomy demand forecast from the International Energy Agency?
Interesting. The oil market is always a complex mix of factors, isn't it?
Yeah, this was reported by Bloomberg, by the way.
Oh.
And the recent price increases seem to be driven by the tighter U.S. sanctions on Iran and Russia.
Right. Those sanctions are having an impact.
Yeah.
And any supply disruption, whether it's geopolitics or policy decisions,
Yeah,
can push prices up.
exactly. As a result, the price of Brent crude has climbed above $70 a barrel.
Okay.
And analysts think Brent could stay around that level for the rest of the year, citing looser supply and demand balances in the second half.
So the longer-term price trend will depend on how these supply factors play out against global demand as the year goes on.
Right. There's also some short-term bullishness because of tariffs on Canadian crude and those ongoing supply disruptions in some areas.
Right.
Oh, one last thing. Barclays, the investment bank, just upgraded RELX PLC, the analytics stock.
Okay.
They cited RELX as dependable growth, which appeals to investors looking for safety in this uncertain market.
Yeah, that's a classic flight to quality trade.
Right. This was mentioned in a MarketWatch report.
When things are uncertain, investors often look for companies with solid fundamentals and consistent growth. Right.
Companies that can weather the storm.
Exactly. An upgrade from a big name like Barclays can really boost confidence.
For sure.
So to sum it all up, we're in a market that's officially in correction territory
Yeah.
and facing tons of uncertainty around potential tariffs.
Right.
We've seen gold surge to record highs, while some Asian markets have shown surprising strength.
Interesting.
The U.S. is staring down a possible government shutdown,
Right.
and retail investors are still piling into stocks.
And we're seeing concerns emerge in the corporate bond market.
Yeah, which could signal broader economic anxieties.
It's a complex picture with a lot of moving parts.
It really is.
Trade tensions, shifting monetary policy, and mixed economic data.
Yeah,
It's making for a pretty unpredictable environment.
totally. So investors really need to stay informed, weigh the risks and opportunities,
Yeah.
and maintain a disciplined and diversified approach.
Absolutely.
We'll see you all Monday morning with new headlines from those major financial magazines.